Welcome back to another episode of Wook Capital Management's weekly Wook in Review broadcast. I'm Managing Director Rod Alsman. I'm joined by my teammate JP Park. We are going to be walking through our prepared content that we have for this, our 33rd Wook in Review. Before I get started, I do need to get a disclaimer out of the way. So if you've been here before, you know the shtick. Just want to ensure that everyone is aware that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. So just FYI, if you are tuned in on Twitter, you're going to get audio only, of course. If you are in the Wook Capital Discord, I am sharing my screen, and I'll do my best to verbalize any of the graphics or visual items that we have on screen. I've got this week's thread pinned here. So we'll kind of just walk through those items, and then we can open it up more broadly, just a kind of in review discussion of what's going on in financial markets. So let me get my screen oriented. We first off have this ongoing Alibaba breakup. There's some more details on it. So we talked about this a few weeks back, that the company was going to be moving ahead with raising capital for these individual businesses. Graphic here from Bloomberg this week, kind of showing where the revenue of the Alibaba group all in kind of breaks out into. It has chiefly the China commerce business is about 70% of its revenue, which is Taobao, Tmall. It's the cloud business is about 9%. It's one of the largest cloud players globally. That's not one of the US mega cap cloud players. There is an international commerce business, the AliExpress, which is 7%. Then they have a digital media and entertainment business, which is about 4%, a local consumer services business, about 5% of revenue, and then a logistics business, which is also about 5% of revenue. So the expectation is that those 6 businesses eventually will all be listed publicly with the ability to have their own capital structures and fund growth for the businesses. This is a byproduct of, I think, crackdowns from regulators that started 2 or so years ago now with the Ant Financial. So this is a culmination, is that we end up with a much smaller Alibaba, the core business, and then all these other businesses. There was a story in Bloomberg today too, talking about the cloud business in some more detail. Some analysts valuing that cloud business at upwards of $30 billion. Right now, Alibaba's, the entire enterprise's market cap for all of those 6 businesses is about $217 billion. So it's still down meaningfully from where it was 2 or 3 years ago, and even it's actually under the IPO price from 2014. So pretty incredible run for Alibaba, sitting at $84 per share versus the roughly $94. We talked last time about how Alibaba had some kind of idiosyncratic headwinds from SoftBank, the largest shareholder, exiting the position or meaningfully reducing their exposure to the position. So it'll be interesting to continue to watch what sort of valuations or the market gives to these different businesses as they continue to spin and transform kind of the amalgamated enterprise. JP and Han, I don't know if you guys have any thoughts on Alibaba. I've I've never been over in Asia, and I know that it's kind of ubiquitous in China, of course, and AliExpress is obviously something that consumers can access here stateside. But don't know if you guys would add any commentary to that. Oh, let me make you a speaker. That might help. So again, just hey, Han.
Hey, Rod. Um, yeah, just quick comment on Baba. I think it's undeniable that it is a solid business, and with this breakup plan, we will. It's more likely that we will see more efficient management and more tailwinds for the business itself. But obviously, I think as we are all aware, all the headwinds coming from the Chinese government and how Xi Jinping is cracking down on all the international businesses. Just a very hostile environment um, for both global business to operate in China, but also big tech companies in China to expand. My question mark for me would be, as these six different spin-offs pursue their different individual IPOs, um, like how will that impact the global markets? And will it be mostly um, raising funds from domestic markets, or will it try to list another, like a U.S. listing? I think that's a question mark for me. But given how everything is, trending right now with the Chinese government, it's looking more likely that they will face more regulatory headwinds as they spin off and pursue more fundraising efforts for these individual entities.
Yeah, there was one analyst in the story I was referring to that I have on the screen, kind of talking about the fact that with Ali Cloud, that they are fully spinning it off as opposed to retaining some minority stake. It, I think, speaks to that Chinese governmental uh, kind of overarching concern that the state wants this enterprise to shrink. And even though the cloud is a longer term growth business, it has attractive margin profile. It just the fact that Alibaba will fully divest it kind of tells you that it's just a very different landscape in China than it was a few years ago, I think. And
Absolutely.
whether we'll see what we see for Tencent, right? Will Tencent be forced, to right size itself, if you will? So, um,
Right.
yeah,
The cloud business is definitely the Chinese government's most sensitive, most regulated part of the business, and I don't know. Just I mean, we're all no one knows what's going to happen, but given that Xi Jinping is already putting kind of you know ex like uh, government security, like spy backgrounds, like intelligence background people. They're getting more power in the government, and I think naturally, as kind of the top people in the Chinese government come from that type of more protective, intelligence focused people, that they will. I think it's natural to expect that the government will put more pressure on data control, especially when it comes to you know big tech companies with the infrastructure to develop a large cloud business, from getting too big and getting too much control over the people's data.
yep, yep. Okay, sorry about that. My audio got messed up from the incessant spam phone calls I've been getting all week. I get dozens of phone calls every single day trying to sell me health insurance. Somebody put my phone number in somewhere, which sucks. It's endless. Okay. So yeah, what I was going to say that is kind of a corollary to what you were talking about with Xi. There was a comment he had made a couple months back talking about CATL, which is the Chinese battery giant, who is the biggest player globally, contemporary Amperex technology, CATL. He had said he was both pleased and concerned about how dominant that company's position had become. So it's kind of similar to Baba, if you're a big player, it's one. At the end of the day, your business is heavily reliant on how the Chinese state treats you, and that's clearly been an overarching risk for non-Chinese investors when it comes to trying to make investments in these Chinese businesses. So, yeah, I don't know if anyone listening had any thoughts on Alibaba or on China more broadly. I'll just make a couple comments from the data that had come in from China earlier this week. I'm just trying to pull up my notes. There was, um, there have been calls for incremental stimulus because some of the economic data that's come in is kind of lackluster relative to what had been expected for this recovery in China. The property market still pretty weak. Consumers reluctant to borrow. The People's Bank of China had hinted that it will maintain supportive policy. So whether they lower reserve requirement ratios or they cut interest rates remains to be seen. But it's interesting because China is kind of at one end of their monetary policy where they're actually looking to be supportive and encourage growth, which is of course not what is really happening here stateside in Canada and the EU, et cetera. So that's kind of a little bit of a China update. I'll keep going though. So the second item that we had in this week's Wook and Review write-up was on Meta, which we got incremental news from Meta today. So we'll talk about both things. For one, it was a story in CNBC talking about Meta announcing its own AI chips that it's developing. So the chips will eventually power more advanced metaverse-related tasks such as virtual reality and augmented reality, as well as the burgeoning field of generative AI. So we also saw today that Meta has announced a Twitter competitor that they're going to effectively create this. If I can get the news from today, that they're basically going to have like an Instagram version that's like a Twitter rival. Okay, I saw the news today and I'm struggling to find the link. So give me a second. Okay, so Instagram's new Twitter competitor. Here's the story from The Verge. And it's a text-based app that'll let you create Twitter-like posts on your timeline. So it's just really wild when you think about how much price can drive sentiment. When you think about Meta, a stock that just a few months ago everyone was certain it was dying and it was over, so over, as they say, when the stock had traded down to 2015 levels in late last year. And since then, the stock has rallied over 130% or so. So the business didn't change like that overnight. Just a very good example of how much sentiment drives price, or perhaps it's the other way around with Meta. But it's interesting to see that they're going to have a Twitter competitor of their own that's coming out. They've had pretty good results from their own social media apps, and then we've got the question of TikTok now seeing its first ban in Montana. They've made it so that downloading the app in the Apple or Google app stores is illegal in Montana. So there will be a $10,000 per day fine for violators, which this is the first time there's been, I guess, a state level ban of an app like this, or which we know there's been discussion at the federal level. This has probably been somewhat of a boon for sentiment towards Meta as well, with the assumption being that if TikTok goes away, Meta gets incremental ad sales and eyeballs on its own social media apps. So there's a decent amount of moving parts. Meta certainly run up a lot. It's on its face not crazy expensive. The forward valuations are still cheaper than most other mega cap tech plays. It's actually got still just a 19 times forward earnings, but again, kind of a night and day from it had actually become a value stock. Both Meta and Google had briefly been treated by the indexes as value stocks. They are no longer value stocks in the eyes of the indexes, but that is how sold off they had gotten last year. So yeah, I mean, custom computer chips, it seems like this is a story that we're just going to keep seeing from these mega cap companies that they want to be all like Apple eventually, kind of having their integrated hardware and software. Um, so yeah, Meta disclosing its first internal silicon chip projects for the first time this week, and then rolling out its own version of Twitter. So I'm sure Mark Zuckerberg is enjoying his barbecue of late. Had a nice time at a jiu-jitsu fight or something like that. If you saw that, not sure if anyone has any comments or thoughts on Meta or on kind of those themes in the mega cap space.
Yeah, I definitely saw the Mark Zuckerberg at the jiu-jitsu competition. It seems like he's passionately pursuing his interests and being very public about it. Kind of funny news to see, but definitely crazy to think about how Meta was trading at below $90 not that long ago, and it's already up so much, and they're already eyeing kind of that hard expanding into that hardware business, as you mentioned, trying to become more like Apple, which I think is good to see from a company like Meta, but also Meta's previous efforts in getting into hardware has not been as successful as other companies that we see in the U.S. that are good at making hardware in general. So I'd be curious to see how their new efforts in expanding into this chip business will turn out. But it is a good kind of tailwind to see Montana block TikTok, which I think it's a very interesting statement from Montana's end, because I would imagine that it'll be tough to enforce this. I don't think people living in Montana will be stripped off their right to use TikTok. And if they wanted to find a way to download and use it, I'm sure they can. But it's a great kind of it's a statement, right? And it'll be interesting to see how much traction this conversation gains, in in reaching the decision whether to ban TikTok on a national level or not. But it's good to see some more steam kind of gain in this conversation for sure.
Yep. I'm just seeing, it looks like TSMC is likely the one who will be producing the chips that Meta is, I guess, designing in conjunction with them. So similar to Apple. Okay, so let me keep going. We saw Elon Musk's anti-Semitic dog whistles of sorts, unhappy with Mr. Soros's, I guess, sales of his stake in Twitter. His family office exited their Twitter, or not Twitter, sorry, Tesla, the other T company the guy is involved with. So Soros Fund Management sold about 132,000 shares by the end of, or sometime during the first quarter. Tesla stock obviously jumped a lot from where it closed the year at. Another beneficiary of this massive influx of liquidity into these stocks year to date. So Tesla, similar to Meta, had traded down pretty significantly in December. By year end, it closed around $110 or so per share, and now it's trading back to $180 per share. So a bit under a $600 billion market cap company. It's still worth more than every other car maker combined in the eyes of market participants, for the most part, 50 times forward earnings. Mr. Musk, well, was unhappy, I guess, that Mr. Soros opted to sell, but Tesla's clearly facing a lot of issues on the demand front. It's a discretionary product. It's a high cost product. Cost of financing continues to degrade demand for that product. and consumers being pinched is not helpful for Mr. Musk in this regard. So they had a presentation earlier this week that Mr. Musk continued his very very, I don't even know what word to call it. It's just chicanery, frankly. But he said that Tesla would be a 80% gross margin business eventually because it's going to have all these robots and robo taxis. So even though today it's about 20 something percent gross margin business, it'll be transformed. Which we're still waiting on those robo taxis that were promised about almost a decade ago at this point, Elon. So I'll believe it when I see it, although the market is giving them a lot of credit for these growth initiatives. Still unsure how much of it is based on momentum and flows rather than underlying expectations of reality. You guys know I have my feelings towards what Mr. Musk promises versus what he delivers. Yeah, not sure what else there is to add to that. I mean, in conjunction with that, we've talked about it in a couple of these, but it's not just an issue that Tesla is facing. The fact that consumer delinquencies are rising meaningfully in the automotive lending space, especially younger consumers. There was a good story in the Wall Street Journal earlier this week that I just pulled up. It had some good graphics, kind of breaking out the different age buckets, and who is most stressed, and it really speaks to what happens, right? If the 18 to 29-year-old automotive borrower is already seeing delinquencies rising toward GFC levels, especially subprime borrowers, well, this is happening while their student loan repayments are paused. So it does feel like there's going to be a very steep cliff for some consumers in August, whenever that switch is flipped back on. So whether it's an uptick in delinquency of the loans themselves, if they begin having to pull back on paying other bills due to the renewal of the student loans. I mean, this is something we're watching quite closely for much of this year. There is still some excess savings across the consumer broadly, but there's definitely a lot of pockets of weakness. And I think that weakness is not good for, say, Tesla when you're selling a premium priced discretionary product with the high interest rate landscape. And yeah, we'll see what the trends look like, in the coming months as it relates to those student loan repayments. So, got one more item, and then we can be done with kind of the prepared content and see where people want to take the conversation. I just lifted from one of the small business surveys showing that there's been a pretty meaningful deterioration year to date in the share of small businesses that expect to increase their headcount over the next 12 months. So for all of 2021 and 2022, more than half of small businesses, and for much of 21, it was more than 2/3 of small businesses. Well, now we're in 45-ish% of small businesses, so less than half for the last month or two, and that's a second month in a row, first time really since things got ripping in 21 that the majority of small businesses do not expect to increase their headcount. So more kind of worrisome trend in survey data that the employment situation is deteriorating. Although, as we've noted multiple times, the question is really how steep that deterioration becomes, because as of yet, it's been pretty mild, and broadly, the employment situation is still very strong. So, Han, I don't know if you'd add anything to that, or if there are any other data points that you've seen that you wanted to share. Okay. Well, that's all I had for our prepared content. last one I've brought you up. If anyone in the audience wants to come up and ask any questions about any of the prepared material, it's about 4:30 here Eastern, so we'll run until 5 o'clock, or if we have a good robust conversation going, we can run until 5:30 or 6. So yeah, we'll see where we go. Last one. What's up, man?
Yeah, what's going on? I kind of entered the chat kind of late, but I saw the headline with the Meta. I was wondering what you were talking about the Meta. Were you talking about they're trying to make like a Twitter competitor? And what do you think about that? Uh,
Yeah, we talked about them designing their own chips, and we talked about the announcement today about them launching their own Twitter, trying to launch a Twitter competitor through Instagram. I don't use Instagram. I have an Instagram. I don't use it. I try to not to use this. Sadly, this social media app is one I use, and Discord to stay in touch with people and kind of stocked with some of the financial social media apps. I don't really use social media otherwise, so I don't know. I'm not. I
well,
haven't
my
really
my
heard from
question is,
Instagram users what they think of it yet.
let me refine my question again. My question has to pertain to how do you think it's going to help its share, like a share value? Do you think because right after the report came out, like I bought some Meta, like thinking like the market would perceive that like a good thing, and all of a sudden it started selling off, and then I started hearing some analysts, and they were saying that they're concerned that Meta's going to start spending again, like their capex, and that's why the shares were. That's why the market didn't perceive it as positive as people would think.
I mean, we were talking earlier about how much Meta's stock has already kind of rallied from where it had gotten down to, which was a pretty extraordinarily depressed level, right? You're talking about a technology company that, for a time in November, December, was trading, like a value company, had a single digit enterprise value to operating income multiple. You don't see that in tech companies. Um, so it's still not rich from where it's at today relative to where it's been, over most of the last decade, but it seems pretty fairly valued. Um, I don't know how this sort of thing, unless it really took off, would be enough to move the needle for a $630 billion market cap company. They need to really have a compelling option that started to really take share from Twitter. I mean, this Substack had rolled out some content that was more like Twitter, and I'm not seeing that gain traction just as an observer. You've got Blue Sky, the new Jack Dorsey project. Somebody had sent me an invite, and I haven't even signed up for it yet. To be honest, I can't imagine it's. So I think the one thing to remember is how powerful network effects are, and if you are Meta and you have a massive user base already on your Instagram platform, you kind of have an advantage that another new entrant wouldn't, right? So I do think there's something to be said for that you've got, however many billion users of Instagram, that if you're going to give them some text-based means of communicating that's not just photos, may have a better opportunity to take share from Twitter than, say a startup player who doesn't have that.
And you got any thoughts on the video's earnings next week? Do you think it hit the 350?
I don't think that fundamentals mean anything for that company. It reminds me of Cisco in the late 90s. Everyone's betting on AI through NVIDIA. In the late 90s, everyone was betting on connectivity through Cisco. And while those trends were massive macro trends, the forward return profile when you're buying a business at that sort of valuation is typically atrocious. So I think that anyone buying NVIDIA at these levels for anything more than a quick flip is likely to lose a lot of money in the coming years on their investment. But we'll see. Maybe this
Yeah,
time it's
because I had
different.
bought options on the 15th for the 350 Nvidia. There were like the options for next week, and they're like, I think they were like 50 cents or something. Like 50 cents. I think I got it for 30 cents actually, but at that time, and then it went up to like $2 already.
beauty of short-dated leverage.
Yeah.
Yeah, I, in my personal account, remain short NVIDIA through put spreads. I did convert some of those spreads into just long puts yesterday, actually, on what seemed to me like maybe the final top, but it's probably going to go to 400 now. Who was it? Let me add, if I can find the link. There was a good graphic shared earlier kind of showing how extraordinary NVIDIA's price to sales ratio had become. It's almost 30 times sales. And, you've probably heard people kind of remarking, and in line with what I was just saying, that typically forward returns when you invest in a business at 30 times sales, it's already valued at, nearly $1 trillion, are unlikely to be favorable in that scenario. But we'll see. Right now, the market cares simply about momentum, and fundamentals don't seem like they mean much. All right, there we go. We add Charlie Bolelio's tweet from earlier to the nest. That's interesting. We, talking about tech a lot today. The spread between tech and really everything else year to date, it's just phenomenal. Nasdaq is now up 26% year to date. Dow Industrials are effectively flat year to date. The small cap Russell 2000 up 1% year to date, and the S&P up 9%. So it really shows you how narrow the year to date activity has been, really in cryptocurrency and your shittiest of shit risk assets, shit beta, whatever you want to refer to it as, your long duration Nasdaq. So it's it's just really difficult to square the circle with a lot of these smaller cap companies and value oriented companies trading at multi-year or multi-decade low valuations, and then technology companies seemingly being in a resurging bubble. A lot of it seems like a bet that we return to ZIRP policy, zero interest rate, in very short order, and that those long duration companies are rewarded disproportionately from that sort of policy. Although the Fed, of course, is maintaining that they're going to remain at these rates for some time. There was the Fed speech this morning, Powell talking about how because of the bank issues, they likely won't have to raise as high as they otherwise would have. Markets seem to have took that as justification to reduce the pricing of there being one more rate hike. It had been a bit over a 1 in 3 chance entering the day, and while my internet is frozen, it had gotten down to something like a 1 in 6 or 1 in 7 chance as today progressed and after those comments. So, we talked about the debt ceiling situation. There's not too much else to report other than today. Apparently, the Trump party folks walking out, the former president telling them that they should allow the debt ceiling to be breached. So it'll be interesting to see, because that party is so kind of stuck on that guy, to see how much some of the politicians in Congress opt to go along with his guidance, and whether we can actually get a resolution, because it looks less likely today than it, I guess, did yesterday. But markets are still seemingly ignoring this looming threat for the most part. Okay, so yeah, any other comments? If anybody wants to ask any questions, feel free. I've gone through all the material I had prepared. As I was just saying, we have a supposed pause in the talks going on with the debt ceiling situation. So you have the former president encouraging his party to allow the breach. It will be interesting to see how the House Speaker navigates this. It's a very challenging situation for him after having the longest vote, I guess, session in over 100 years for him to be elected Speaker by his divided party. You probably have a little bit of, if I'm the president, and I'm trying to negotiate with you, and I know that the person who holds sway over your party is saying to do one thing, and the guy who's actually the speaker, who doesn't maybe have as much power as he would like to have, wanting to do another. It's just it doesn't look good from my vantage point. It really looks more likely than it's ever, and the market's not really pricing this risk in, which is more of a tail risk. I saw Boaz Weinstein, a hedge fund manager, kind of remarking on Twitter. If I can pull up his tweet, he was remarking on how low the pricing was for the credit default swaps. I quote, this was 4 hours ago, I just now got a live quote on December expiry, US CDS at 215 basis points. Sounds expensive though, maybe not given the walkout that just occurred. CDS max loss is 125 points to make, say, 35 to 45 points. So you're talking about if you're going to make 40 on 125, that's a 30 plus bagger. It's a pretty darn good return. So if you think there's a more than 3 or 4% chance of this breach happening and the CDS paying out, then you'd think that's a pretty good bet. So he notes, if anything, that feels low given the news and Trump's comments over the weekend, which I was just referring to. But even lower to me is June VIX at 19.5. Lots of ways to win aside from debt limit, not a binary outcome like CDS. Very little room to explain why you didn't hedge after this week's SPX melt up. I did hedge on my personal account. I bought shorter dated puts for the Qs, as well as for Apple and NVIDIA, or sorry, not NVIDIA, and SPY. And I added to my Jan 24 out of the money puts because I felt like, again, volatility is very inexpensive if something goes wrong. And while the nature of the beast is we don't know what's going to happen, I think Boaz is on the money there, that it seems like what is priced into those credit default swaps and to VIX are less than the real risks of the politicians getting this wrong. So, again, welcome any thoughts from folks in the audience. If you think, no, Rod, you're wrong, actually, the chance is less than that, or, if you're feeling similarly. Otherwise, if no one else wants to chime in, I really don't have any other prepared content, and we can wrap this up in short order.